how do you see these intraday target vol indices working? What do you think it's the main advantages, and of course, like, the risks that it comes with them, of course.
Yeah, I mean, so intraday, I would say, is an evolution on what we already had before, and so I mean, the whole wall control indices, call it risk control, target wall, have been in the structured product space for more than 10 years. Actually, a lot more than 10 years. We are close to 20 years now, and people learn from experience. And one of the challenges, I mean, I can tell you from my experience back when I was on the trading desk, was that in the morning you come in, you see there's a bad news come in, market's going down, and then the only time you're going to measure your risk is at the close of the
Certainly.
day,
Yeah.
and then you're going to get exposure out at the end of next day. So you literally are just waiting for 2 days, waiting for this thing to readjust. And you would have sometimes clients calling you and say, "Oh, I see the market going down. When are we going to exit?" And I'm like, "Well, wait
You
for
need
next
to
day."
wait.
And that was, I would say, a very much a technology limitation on how you could actually do this a lot earlier. And that's where I think intraday comes to play, where it actually allows you to measure your risk during the day. It allows you to sort of exit during the day as well. And in that sense, it actually, to your point around the whole thing about the V shape and stuff like that, it allows you to also time getting in and getting out a lot more quickly. So it has definitely those benefits. Another benefit you can actually see is with the close of the day, one of the challenge was that all the execution orders had to go at one point in time. All these risks measures were based on one value. And we know one thing in finance, there's noise in these values. So if you're going to measure your risk based on just one value a day, you actually are bound to get a much more noisy indicator, which is where the whole smoothing would come in, but it's still a noisy indicator. And if all the orders have to go at the same time at the close, the dealers have to really plan accordingly. And it comes to the liquidity question as well.
Yeah.
How much product you can write on that index if you can only execute so much.
Right.
So with the intraday, you actually tend to solve that problem because in case of intraday, you would say, I would measure my risk over, let's say, a 10-minute period. I will take the data of a 10-minute period, it's my window, and I will observe the price in this time. The concept of this window means that you're able to sort of remove some of the noise because you are now averaging the prices like TVAP methodologies you'll use, and it gives you much more stable risk band measures. On the dealer side of thing, because now they also get to execute over a window, they actually have got a much more time to put those orders in. And they
No.
don't need to lump a huge order and put it at the close because the intraday will gradually take your the leverage down. So you actually break your orders into multiple chunks and still actually execute them over a wide window. So from a more hedgeability point of view and investor point of view, it actually seems to work better. So we see these benefits coming up, and you're right, there could be more turnover. But and from the indices that we have worked on, we have seen that generally the returns, the benefits, they outweigh this turnover
The
cost.
costs. Yeah. And you think the cost is the biggest, let's say, side compared with other risk control indices, or is there something else I'm not seeing?
So I mean, your cost, I actually refer to the turnover cost here.
Yeah.
So the amount of execution cost you're actually putting in. There's also a cost around the operational side
Mm-hmm.
because now you're not measuring it once a day. You actually have to observe it multiple times a day, and so there's an operational cost say on our side because we are calculating and maintaining these indices. We have to make sure the data is accurate much more frequently, and the data has to be disseminated on time to the dealer so they can execute them as well. So there's a bit more operational risk as well, which adds some costs as well. So there are some additional costs on that front. But the benefit that we find is that if the returns are better and the indices are now able to react a lot more faster, that actually helps. Another benefit we find is that, when we talked about target wall, we said there's a threshold and then the wall is around a band. If you are able to execute a lot more quicker, you are able to reduce the size of the band, which also means you are now getting exposed to a much exposure to
Closer.
a wall which is
Yeah.
closer to what we intended. And for the dealers, it also means that they are able to also price these options slightly more better because they have much more certainty where that band is,
Okay.
and it also helps in product creation. But having said that, look, I mean, there are a lot of positives around the intraday. There are also negatives because there's a big now data side. So you can't just roll it out on just any underlier. You need to for outliers that have liquidity throughout the day,
Yeah.
but cheap enough to execute. And you also, because it gets operationally intensive, you also need to engineer them for products that are being traded for decent size.
Right.
You can't have small clips, small ticket sizes for these indices because the operational costs will be just way too high
Yeah.
to satisfy these indices, to support them.